Well, investors digesting the latest consumer inflation print as the strong report is likely to keep the Fed on track to hike interest rates and signals a likelihood of further increases as recession remains top of mind. We'll hear more on the inflation expectations and what investors could do amid a more hawkish Fed. We have Jordan Jackson, JP Morgan Asset Management Global Market Strategist. Good to have you here on the show. So, first, I want to talk about this market repricing. Has it finally sunk in that the Fed is more hawkish than they expected?
To some degree, but not fully. The terminal rate, in terms of the peak rate that the Fed will get to at some point in the first half of this year, is now at roughly 5.2%. So markets are appreciating roughly two more rate increases, one in March and another one at their May meeting. But markets are still anticipating roughly one rate cut still in the back half of the year. And again, the Fed continues to profess that they're going to stay higher for longer. This suggests that they'll keep rates above 5% for the duration of 2023. And they're getting signs that they've been right on this call. You think about the strong BLS employment report in January. You think about the recent CPI print this morning, which still suggests that, yes, the disinflation process has begun, but the Fed probably feels like they have a lot more work to do. So I think, the Fed is doing a little bit of hand-holding, getting the markets closer in line to what they're calling for, but we're not fully there yet.
So when we look at the month-to-month versus the year-over-year for the core CPI data, what is that signaling then about how much longer the Fed will go and for how much longer? Or could even a pause be on the table at this point when we do have this inflation print?
Well, of course, the wild card continues to be sticky shelter inflation. Now, we can argue at length in terms of the BLS's calculation of shelter inflation and how it lags real-time lease rates as well as home price appreciation or depreciation. But it does suggest that shelter might continue to stick around at least for the next couple of months before it begins to decelerate. Also, I think we did see a rise in the Manheim Used Vehicle Index, and some proponents were expecting we were going to see a tick up in used vehicle prices. We actually saw that come down, so that might have been a welcome number from the CPI print. But all in all, I still think that this is going to be a bouncy ride for inflation on the way down. Now, the Fed continues to talk about core services PCE inflation ex housing. Now, that figure has been trending down somewhat, but again, it's still sticking around a bit higher than what the Fed would like. Right now, year on year, it's running at about 3.8%. That longer run average is about 2.5%. So all these signs suggest that the Fed, again, still has a little bit more work to do. And I'm not sure markets still appreciate just how much higher and longer the Fed is willing to keep rates.
And it's interesting because when you look at how disinflation is affecting goods versus services, and we know that Powell was especially honing in on the services aspect here. I mean, do we get the sense that we can avoid a recession if we don't get that aspect under control?
So I really struggle with this idea of this immaculate disinflation, right? I.e. inflation coming back down to the Fed's 2%. Us being able to avoid recession, and then the Fed turning around and being accommodative sometime later on this year. It's very unlikely for all those three things to happen. I think you need to have some pain in the labor market in order to get that inflation rate back down into the Fed's ballpark. And so we're not seeing that the economy's coming under some pressure, some braking power being applied to the economy, but it does suggest that we can continue to hang in there. But if aggregate demand remains strong, that would suggest that inflation can continue to run a bit hotter than what the Fed would like. And that positions the Fed to, again, tighten a little bit more aggressive, break something in the economy, and dip us into a recession sometime in now, I guess we're pushing it back maybe a quarter or two, the end of 2023, earlier parts of 2024. So I think the market, this rally so far this year is maybe a little bit premature. We're not out of the woods yet for higher rates for longer, and that's going to bite further on down the road.
So then what's the investment strategy here when you do have markets moving in one direction while the Fed's still trying to beat the drum that they're going to be more hawkish, potentially an extra 25 basis point hike ahead somewhere?
Yeah, I think you still position a somewhat defensive. I think there could still be some pain amongst tech stocks. Again, if we're talking about higher rates for longer, that's going to be a bit of a headwind to longer duration equities like growthier parts of the market, like sectors like technology. Also, we can't ignore the earnings backdrop. Some of the forward guidance that we've gotten hasn't been very constructive, particularly amongst big tech. And so I do think there could be a little bit of weakness there. If you think about the bond side of the equation, for the first time since the early 1980s, you now have paper 1 year and under or maturing in less than a year that's yielding more than intermediate core bonds, than the Bloomberg aggregate. And so, if you're looking for income, just a comfortable place to park your cash, cash is a decent alternative at this stage. But if you are looking for protection, insurance, if you buy into the idea that the Fed is going to keep hiking rates, want slower growth in order to bring inflation down, you've got to own a bit of protection. You've got to own a little bit of duration at this stage. And with the U.S. 10-year now touching 375, I do think this is an attractive level for investors to begin engaging a little bit of duration in high quality core bonds.
Certainly, everyone has to do their homework and decide on their risk tolerance and, of course, their time frame as well. A big thank you there to Jordan Jackson, JP Morgan Asset Management Global Market Strategist. Thanks so much.